All right. Good morning, everyone. Near last or very last track here. So,
Free lunch. We have one more.
okay, got it. Well, hope everybody's enjoyed the conference. I'm thrilled to present here. I'm actually filling in for Nathan Pund. If some of you know him, Nate leads our active lifestyle practice at Houlihan Lokey. He had a conflict pop up last minute, so I apologize. You're stuck with the B team today, but I'm thrilled to be here speaking with you all. So I'm going to talk a little bit about Houlihan Lokey, what we do. We are a global investment bank headquartered in Los Angeles, offices all throughout the United States, as well as Europe and Asia. Our team is really specialized in mergers and acquisitions. As you can see here, Houlihan Lokey leads the M&A market in terms of deals that are done across all industries, ranging healthcare, industrials, consumer products. We do more transaction volume as an investment bank than any other middle market or large financial advisor. So you can see here within what we call corporate finance, that's across all industries, consumer products where Nate and I focus, and then really what's important to probably you all, active lifestyle and outdoor. And that encompasses everything from hunting, shooting, fishing, climbing, fitness, you name it. If it makes you sweat or has you being outside, chances are it is in our coverage universe. So we like to joke that and Nate and I have one of the best jobs at Houlihan Lokey because not only do we get to work on transactions and work at a large firm that brings a lot of resources to the outdoor industry, but we get to have a lot of fun along the way. So in my career, I've worked with a lot of founders that are looking to exit their business, help them find the right buyers, the right fit, and then also kind of achieve their objectives. Whether it's I want to, still have some involvement in the business, no involvement in the business. We help them with kind of succession planning and how that works in a post-transaction kind of world for them. So a little bit about us. What we're going to talk about next really is some dynamics that have affected the transaction environment in outdoor. Starting with, we're going to talk back to 2020, 21, COVID kind of boom and bust, being really some of the scariest times. But then from a transaction perspective, valuations were very inflated. Transaction volumes were at record levels, all the way down to companies having excess inventory that was hard to sell through, discounting. And now, as everyone probably has heard a lot about or focuses on almost daily, the current tariff environment under today's administration. So we're going to talk a little bit about that as well. You'll see here, just to give you a broad sense of the market, if you're looking at kind of the index funds, for those of you that have investments here, under the current administration, everyone's actually feeling pretty good about where the broader market is. You can see here, looking back from 2020, there's kind of the pandemic era, boom and bust, where really stocks performed incredibly well. Then a pullback after that as people were fearful of recession, the collapse of Silicon Valley Bank, and then really, for the most part, aside from earlier this year, Liberation Day and tariff concerns depressed the market. However, there's been some recovery since then. So this is just setting the landscape for kind of the broader market. And then now we can go talk a little bit about how the active lifestyle and outdoor market has performed through a similar lens. And so again, you'll kind of see 2020, 21, absolutely phenomenal performance in the active lifestyle and outdoor space. You can see through 2020, 21, again, our team was incredibly busy in executing transactions for founders and private equity firms looking to exit. And then again, as we got into 2022, there were recessionary fears. And then now you can see that the sector has been really challenged by the current tariff environment and concerns there. And I think our thesis and philosophy is that until there's some resolution on that in more of a concrete way, this level of uncertainty and muted performance is going to continue. Now moving on to just really kind of broader M&A activity. Houlihan Lokey as a firm tracks transaction volumes and values across all industry sectors. And so this is really a view of all M&A activity globally. And what the conclusion of this slide really is in today's environment, fewer transactions are getting done. And the transactions that are getting done at really, honestly, premium valuation. And the reason for that is everyone is a little bit concerned about business performance, tariffs, all the things that we've talked about. For those assets and businesses that have been able to cut through the noise or somehow insulate themselves, that's reflected in their financial performance, there's a lot of competition in the buyer universe for people trying to participate in those deals. And so the more folks participating in deals, the higher level of competition in an auction process if you're trying to sell your business, driving value up. However, buyer skepticism on assets that are impacted by tariffs and recessionary fears and overall consumer sentiment being shaky, those deals have been more challenging to get done, or there's a wait and see or hold approach to businesses and experiencing kind of those factors. So there's a lot of investor appetite out there, but people are being very selective in where they spend their time. A little bit more, really, if you look at M&A transaction multiples over the last 10 years, the median multiples north of 12 times, pretty healthy. If you look at kind of where we are today, multiples last year just shy of 10 times. This year, for the first half of the year, 9.8 times. So we're well below kind of the 10-year median, and again, that's due to all the factors that I spoke about today. So, then moving on to how do deals get done. A lot of people use debt financing, and there's a lot of data on this page, but I think what I want to hit on really is pricing and leverage. Even in this market, lender appetite for doing deals, just because they have had lower volumes of activity in over the last 18 to 24 months. They've gotten a little bit friendlier to the M&A environment, and so they're offering higher levels of debt financing at lower pricing. So that is good for the deal environment. We're hoping that continues. If you look at, we in many instances look at ratios of kind of total debt to EBITDA in September of 2025. So last month, I guess, 4 to 5.5 times leverage is actually a pretty healthy level. And so that's been helpful to the recovery of the deal market as well. Then moving just a little bit closer, now we're talking about what we call active lifestyle. So this is really anything in the outdoor world, data specific. So if you look, what's interesting, we're talking about deal average and median EV to EBITDA multiples in the active lifestyle sector. So if you look at the median over the past, almost 10 years, it's been right around 10 times. If you look at, the median today, it's just shy of 9 times. And so what we have seen in the active lifestyle and outdoor world is it tends to be a little bit stickier than other pockets of consumers. So if you think about this environment right now, probably, Russell and I were just talking, people are being really thoughtful about where they spend their money. So maybe they're not going to take on that extra landscaping project or dig a pool or buy a $15,000-$20,000 couch. Those are all things that people are deferring or being really thoughtful about. But if you look at, the active lifestyle and outdoor market, people are going to go and kind of pursue their passion. And maybe it's a lower ticket item. Maybe it's new hiking shoes, something that simple, but that's something that's held in a lot better than other pockets of consumers. So lower ticket items that make people happy, be outdoors, pursue their passions. That is a trend that has been a long-term constant in the active lifestyle and outdoor world. So that's been a good factor as well. And then finally, we've talked a lot about tariffs. The reality here is there's a lot of uncertainty right now. Everything that you all already know, but you can kind of see year-to-date tariff movement across the U.S. and China. Obviously, in Q2 of this year, a lot of uncertainty driven there. And the way we think about the deal market is we can certainly work with, what we call good news, and that is, perhaps next month when the Supreme Court meets on this matter, that there could be a pullback in tariff concerns and potential implications there, opening global trade. That would be obviously fantastic for the deal market and the broader outdoor sector. And so that would be what we call good news, great for the deal environment. We can actually even work with bad news if it's, hey, this is going to be here for a long term. We can plan on it. But what really challenges the deal market is uncertainty. And so that has the consumer being shaky as well. And for example, one interesting anecdote, Nate and I were working on a transaction a couple years ago in the trail camera space. And what was really interesting about that is it was going on right as recessionary fears were sinking in. So this is, call it mid to late 2022. But when we talk about the passion and the enthusiasm of the outdoor consumer, these products serviced a group of people from all demographics, all income levels. And so that passion of the outdoor industry was really evident in this particular transaction, because you had maybe, Joe the hunter who really was passionate about deer hunting, tracking his buck, and he, would maybe even skip a meal out with his family for a couple of weeks to make sure he had enough money to go to Walmart and get his trail camera, all the way up to billionaire ranchers in Texas that had hundreds of them covering, acres and acres of property. And so, that's just an interesting anecdote about the consumer and the stickiness, and how that all kind of helps fight a little bit through some of the tariff uncertainty in consumer products, but still a lot of uncertainty out there. And I think that is it for me. Thank you, everyone. Appreciate it.
Wrist. Yeah, there we go. Yeah, and similar to Seth, M&A advisory firm with Bell Lap Advisors. Different that we focus on $5 to $50 million, which kind of slotting in before where Houlihan would jump in for those bigger deals. A little bit of background about myself. Maybe slightly different than a lot of investment bankers. I don't know if I'd call it a career, but my early part of my life was just being a bike bum, traveling around, mountain bike racing, road cycling, teammates with this guy 20 years ago. Somehow we're up here together now. And then, actually undergrad, I studied exercise physiology and chemistry, and then I went on and got an MBA, and then started my own business delivering fitness services through technology, raised some capital, and then sold that to a private equity-backed healthcare business. and then had 1 year consulting agreement, did that, took a year off, wasn't sure what I was going to do next. And I worked with a boutique investment bank that one of my friends worked out on that deal. And he was like, you like putting deals together, come work with us. And I was like, I don't have much else going on. So sure, give it a try. And that was mostly consumer focused work, and really figured out that I do like putting deals together, but maybe even more than like the transaction itself. I like working with entrepreneurs and, kind of shepherding them through, perhaps one of their biggest life moments, right? Selling your business for a lot of, especially in the outdoor industry, probably next to having kids and getting married, it's probably going to be one of your biggest life moments. It's not Silicon Valley where you start a business on day one with the goal to go sell it. Most people in this room probably started it because it was a product that they wanted for themselves, and then turned out that their friends wanted it and even more people wanted it. And then years later, they look back and they're like, I got something that's worth 10, 20, $30 million. And it's in the kayaking space or camping space because I love kayaking and camping. But now my business is so big, all I do is stare at spreadsheets and never actually go kayaking or camping anymore. So maybe it's time to transition out of that and get back to the outdoors myself. So I just love working with people through that process. And so I did that firm for a few years, and then I just ended up having a business kind of coming to me directly. And, was bouncing between doing an outdoor deal, but then a furniture deal or a, children's product deal. And I was like, I'm too old to work on stuff that I'm not passionate about. I'd really just rather work on outdoor products. So spun out to do my own thing, and I've got 4 other people that help me out now. Another one, and I'm based in Bend, Oregon, one other guy in Bend, Oregon, one in Portland, one in Kalispell, and one in Amsterdam. And we just spend our day just kind of bouncing from, cycling to the RV industry to trail running to fishing. Then they say the outdoor industry gets pretty small, pretty quick geographically. So, even a small boutique firm, we've closed deals in, USA, Canada, Europe, Asia, happens pretty quick. And really, really just being hyper-focused on, we're able to do those smaller deals because we're hyper-focused, right? We couldn't take transactions that size if we were jumping from a bunch of different industries. We don't have an army of analysts to do that, but because we live and breathe in one industry, we can take those smaller ones that the bigger investment banks don't go after. And I've kind of been saying this for a while now. It's kind of a series of storms that have gone through, but still, I think this still holds true for the outdoor industry when they're looking at deals. Is this kind of good climate, bad weather situation? Overall, the next 5 to 10 years should look really good. The climate is great for the outdoor industry. But it's been probably 3 years of saying bad weather. So, I think we all believe it's going to get better. You guys live and breathe in this industry all the time as operators, so don't have to spend too much time on this stuff. But there are just macro drivers on why this is going to continue to be successful, right? One is just generational shifts in health and lifestyle. People are prioritizing physical and mental health more than ever, and just more experience over results. I think a lot of us that are old enough, when we were participating in outdoor, it was all about, results and getting on podiums and things like that. And younger generations, it's just not as important. It's more about participation, right? Just go out, do your gravel race, your trail running event, but you're stopping and creating Instagram content along the way, right? It's just about getting out there and doing the activity versus actually being at the top, which opens up the market size a lot. And just more logistics, just remote work. People have more flexible schedules now, so they can, live in mountain towns and have better access, or just maybe it's 1 day or 2 days a week that they work remote and they can get outdoors more. Access and technology, I think those kind of go together. Really, that there's more trail systems. There's apps. The products are better. You kind of think about, I think mountain biking is a good example. You think about back when we started in the 90s and we were riding rigid hardtails and getting pinch flats and breaking chains and riding on hiking trails. And then generations today get into mountain biking. What they go buy a bike for $3,000. That's an awesome full suspension bike. It shifts tubeless tires. They don't even know what flat tires are anymore, right? And they go to ride it on a purpose-built trail system with signs, and they have trail forks on their phone so they never get lost. It's like it's totally different experience, right? So that's only going to continue to grow. So if you're an investor and you're buying the future, not the past, right? So you're looking next 5 to 10 years. These things are only going to continue. So it looks great for the outdoor industry, except for the continual storms that have been passing through. And we won't dwell on this because you guys live this every day, and it makes it hard for us doing deals. It's way harder for you guys than it is for us actually to be operators during this time. Yeah, it's pretty tough. Yeah, we all know that things were great during the, I guess maybe we'll call the golden years of the pandemic at this point. And then kind of coming out with that, the inventory glut and margin compression. And then of course, 2025 was supposed to be the year that inventory levels started to normalize and we were going back to full retail pricing and margins were going to be better, just to get, of course, hit with the tariffs and the next storm. But I think we all believe that will pass and we'll be in a good place long term. Other just kind of more global things is just the operations and cost. Outdoor industry has not only been hit with too much inventory and not being able to get full retail price, but everything in your operations is getting more expensive, right? It's not just your tariffed product. It's your health insurance and your business insurance and your rent and everything. So yeah, tough landscape in the moment, but I think we all like to think this is a transient thing and it'll get back on track. And then, I just thought I'd cover, just a few points. After Yoon asked me to do this, I started making kind of notes of the conversations that are happening every day and kind of what the common themes were. The first one isn't necessarily a unique theme. I just think it's unique to talk about really focusing on $5 to $50 million businesses, because it's hard to look at like market caps for public businesses or kind of like PitchBook, Cap IQ sort of data, because it doesn't really capture those smaller deals and there's a lot more variability in there. It's not as easy as just going to market and saying, we got 5, 10, 20 million EBITDA. Things start to be a little more normalized on what you expect versus smaller deals, especially on the strategic side. If you might have a patent, you might have a unique consumer segment and an authentic voice into that consumer segment, or maybe your expertise in a certain channel, and you go to a strategic and solve that problem, they're going to pay for that kind of regardless of what the EBITDA is, right? And we've literally have done businesses that are 10 times, we did one like a $500,000 business that had IP and we went sold it for $5 million because it was a patent, right? So things just get a little more, I don't know if I want to say rogue, but variable is probably a better word on kind of the smaller businesses get. So yeah, multiples are important, but it's just there's so much variability. And even within outdoor, are you a branded consumer product? Are you a retailer? Are you a distributor? Are you a tech business? You're going to see a lot of variation between how those are valued. And then overall, now compared to the pandemic, a lot of people that call us think, well, pandemic multiples were really high. And it's not really on the multiple level, not as crazy as you might have thought. It's crazy because of the EBITDA level, right? But the on the multiple level, there's so much, it's just supply and demand. Everybody that was thinking about selling their business sometime in the next 5 years sold their business during the pandemic, right? It pulled all that forward. So when you're talking to buyers, they'd say, I've got 30 memorandums on my desk for outdoor businesses. So I get to choose, right? It's supply and demand. So it kind of governed that, but it was that EBITDA side that was, I don't know if I want to say it wasn't real, but it was a good time to sell. We'll just say it that way. So, and then, kind of fast forward, just like Seth was saying, and now here we are. It's the opposite of that. People are like, oh man, I bet multiples of just are crushed, right, with all this craziness. And you're like, not really. If you still have a good business, there's not that many good businesses out there for sale. So if you're growing, profitable, willing to go to market, especially if you can get over 2 million, so you can get into that institutional class of investor, you're going to get a lot of eyeballs on your deal. So yeah, not as ready to kind of go off a cliff as some people expect. Yeah, and then with that, even with valuation, terms are equally as important. I think everybody talks about valuation, but definitely the terms of a deal are equally as important. There's a phrase in our line of work, kind of your price, my terms. So you can get to high valuations, but you might have to, have a little more structure in the deal to get there. So, and it's how you bridge. Of course, as sellers, we're going out and we're saying, like, look at this next 12 to 24 month forecast. 100% we're going to hit this thing. Nothing to be worried about. Rightfully so, buyers are skeptical. So they're going to want to pay based on how that business actually performs over the next 12 to 24 months. And that could be earn out or contingent seller notes or royalties or put or call options, different tools you can use to get there. Of course, we don't really push for that. We, of course, push for as much cash at closing. It's usually the focus of our clients, but you have to expect it right now. There's a lot of uncertainty. That's what Seth and I were talking about before this is just, and like if you came to Mike Wallenfell's talk yesterday, I was saying, 70% of acquisitions fail. I like to think it's higher than that, but or lower than that for how many work. But yeah, there's always risk. Buying any business is absolutely risky. So you need to surround that deal. You need to surround that with stability within your product, kind of the category you work in, within the broader outdoor industry, within the U.S. economy, within the global economy. And you guys probably all know how much stability is in every one of those layers right now. So you're just going to see more structure based on that. Other dynamics. There's some PE-backed publicly traded businesses. There's a lot of pressure on them to grow, and organic growth has stalled for a lot of them. So definitely looking at ways to grow. And some of those that bought kind of peak pandemic, definitely, like PE, they bought them. They're on a tight time frame. How are they going to grow? They got to keep bolting things on. Good opportunity there. Distressed businesses, unfortunately, that's a pretty regular discussion. I hear a lot of talk about roll-up plays. I can't say I've seen a lot of them. There's one we're working on that's bought one business in soft goods and outdoors and pretty active and looking for other ones. Strategic buyer pool, definitely a little bit limited. You're seeing some buyer groups be real conservative with their balance sheets that traditionally have been active buyers, but not going out on a limb right now. Tariffs, we know how that is. And I wouldn't need to cover AI. That's just an annoyance for me, the amount of chatter that's causing out there. Like all of you business owners getting emails every day from someone saying they want to buy your business, some robot that knows nothing about your business. And then, of course, when you're talking to educated buyers, they know that, a bit how to judge success right now is different. The days of doubling your business every year is just not reality. If you're staying flat or you're up 10% and that's successful, and frankly, your competitors might be shrinking, you might be taking market share with that success. And then, just say with all this, it creates opportunity. So like Steve would probably say, there's a bike racing analogy for everything in life and business. And, anybody can attack when the pace is easy. The winners attack when the pace is hard. And right now we're going to figure out where the winners are.
Are we good? All right, sweet. Well, here, I'll move forward through here. All right, so I'm Steve, managing partner of Dignitary Ventures. Been around for about 4 or 5 years. Started with my brother-in-law, or my brother. We're both, outdoor enthusiasts. I come from a background, as I said, in the outdoor industry. Quite a few years in the bike industry also. Spent a few years at Microsoft, a number of startups. Really, it sort of became a part of our passion in what we wanted to do. And part of investing in the outdoor industry was also just because we think it's a needed. Oh, all right, cool. I'm getting a phone call. All right, it was something that's needed. We need to sort of give back and support the outdoor industry because it's so important to everything that we do and important to the world in general. So it came from both a passionate thing, but also an investment side. My brother actually came from InsurTech. He made an exit, which was, the multiple was a lot, let's put it that way. And I had to sit him down and say, hey, you know what, when we do this, expect a 2x, 3x, 4x, maybe 5x, let's make sure that your expectations here are reasonable. And he's like, I know. So I wanted to walk you guys kind of through sort of two real world examples. I come from a different perspective of this. I'm on the fundraising side, although I do talk with Russell a fair amount, sort of goes, spurts here and there. He actually provides me a lot of deal flow. We reminisce about our bike racing days sometimes. But I want to talk about two examples. So one is a kids bike company. They asked me to not say their name because I like to fly under the radar. If you do about 2 minutes of research, you'll find out who they are. They've actually been in the news quite a bit through some tariff stuff. And then Hest, we've actually got Aaron here, who's founder and president of Hest. Hest was actually one of my very early investments, and to be honest, very, very, very good, and I'm very proud to be a part of Hest. So let's go through the kids bike company. So they were actually formed in 2010, where they developed like an OEM brake system that was sort of like a safety brake for kids bikes. And for the next couple of years, they actually went out to bicycle manufacturers and tried to sell this into bicycle manufacturers. And it was a couple dollar piece. So they had to sell a heck of a lot of these things. So over the next couple of years, they got this thing into market. And into 2012, 2015, they actually started to get momentum with this OEM spec. And they actually pitched me, I think it was in 2015 when I was working for Excel North America. And they pitched me on this product. And I walked out of the room thinking, wow, these guys are toast. This thing isn't going to work. I feel sorry for the guys, and what they did, if I can do two things at once here, they actually pivoted to start a bike brand in 2015, which was, in hindsight, genius for them because they were able to market this device that they had in the way that they wanted. And they sold it all direct to consumer. So they were selling direct to consumer under their own brand in 2016. And then they appeared on Shark Tank. So they went from the first 5-6 years doing, a couple $100,000, appearing on Shark Tank, only still doing $300K in revenue. I'm not sure how these guys survived up until that point. They acquired funding from Mark Cuban in 2017. 2018, they were doing 1.1 in revenue, 2.1 in 2019. In 2020, they were doing 9.5. In 2021, they were doing 11.1. And then in 2021, they sort of had a sort of stalled in terms of their sales. In that point, we actually, they approached us for investment. And up until that point, they've been running off of friends and family, Safe Notes, Mark Cuban, Shark Tank. They were scrappy. They persevered, and at that point, they pivoted a couple years before that. And in 2023, they actually started to develop their own manufacturing facilities in Illinois. And if you have a chance, if you can find out who they are, I would go see their manufacturing facility. It's pretty remarkable. I had a chance to stop by about 4 or 5 months ago. And then in end of 2024, they hit $100 million in revenue. So in the first 6 years, they maybe made $300K. In the last 6 years, in 2024, they made $100 million. They're on track to make $125 million this year. And just recently, they hit $19 million in financing from JP Morgan Chase. So they had a very sort of not straight path to what success is for them right now. I don't know when they're going to sell. I'm not sure when they'll give Russell a call or Seth, here. But they're on a good path, and they're always going to have challenges in their business, and I'm sure it won't be a straight line. So let's go to Hest. I hope Aaron doesn't mind my pun here, Steady Betty, because he's had one of the probably straightish paths when it comes to investment and sort of like in working with him. So 2016, he had the initial product idea, prototyping. In 2017, he formed a partnership with Ideology, which he developed the product with, if I'm saying that correctly. I've got him in the audience. I got to make sure I'm saying this right. And then 2019, Hess launches via direct to consumer with one product, the sleep system. And then just as COVID hits, he ships his first pallet to REI and ran out of money. Had to work with the factory to keep product flowing, which was a good thing because, as we all know, there was a nice bump as COVID went along. And then in 2021, he was able to switch to full-time, reach about $1 million in revenue. And then in 2022 to 2025, he's had steady growth. I always make the joke when I put my investment newsletter together, I sort of just repeat the same thing for Hest. I was like, they're growing year over year. They're doing great. They've got more products. Happy, thumbs up. That's usually not the things that I put in my investment newsletter when it comes to different companies. Just recently, just in the news, they cleared a 2.7 million Series A, which is mostly committed. I joke with Aaron that he was able to fill that Series A in days, but in fact, he spent a lot of time over the last 6 months to a year to fill that Series A. But as Russell said, good companies are getting funded. If you've got a great idea, you can still get funding. So there's still money out there. It's just not a lot of people are, much like myself, with a fund to be able to fund these companies. We're being pickier. We're diving in a little bit deeper. But man, if you've got a great company right now, there's not that many, and there's money available for you. So just keep that in mind. And then my last little tidbit here, it's sort of a new world of fundraising, investing in fundraising. Typical venture capital, angel investors, private lending, accelerators, crowdfunding, mom and dad, both these companies used a combination of those. In these days, there's sort of those not so typical unknown ways to get fundraising. Grants are a great way to get funds for your company, or even moving to a different state or city, you can actually get money. Shopify, QuickBooks, that was mentioned yesterday, where they do short-term loans. Those have been huge for a number of these companies. Credit lines. And just recently, I had one of my other investments called Wild Rye, which is a women's clothing brand. They're doing really well. They just did a WeFunder. And if you don't know what that is, it's basically like the Kickstarter for investment into your company. If somebody had told me that they're going to called me up and said, hey, I want you to invest in my company, and I'm also going to do a WeFunder. This is like 3 years ago. That would have been a red flag. I probably would have been like, sorry, I'll let, 400 people be in your business. I don't want to be. But now it's an accepted practice. I mean, it's something that in the right circumstances can be really powerful for your business. It's including your consumers into your company and letting them invest both financially and emotionally into your company. So, nowadays it's like, man, if you're going to do a WeFunder, sure, let me hear the circumstances. Let me understand how you're going to do that. And I may just be a part of that. And heck, I'm probably going to promote it, as a part of, Wild Rye's WeFunder campaign. And it was great. She raised, I think she was up to $900,000 the last time I checked. And I don't know if Andrew from Livesyn is here. All right. Andrew, I think you just kicked yours off a couple weeks ago. Yeah, 355. So, it's really great to see. So, I think it's tough to start a business right now. If you've got a good idea, you've got perseverance, you've got staying power, you work your tail off, it's still able to do it. And I think there's other opportunities to get that fundraising, to get that great idea out there. So just a little different take than maybe these guys, but yeah, I think that's it.
Very good, Steve.
Yeah.
Thanks so much. And we have time for just a few questions. So who's got one that's going to fire up the crowd here? Yeah.
Oh, yeah.
So we heard a lot about tariffs, and I'm curious to know, do you think that the outdoor industry is being more impacted equally or less impacted versus the larger economy by the current tariff situation?
I mean, it depends on which category, I think. Like I'm fairly involved in the bike industry, and they've been impacted quite a bit depending on which day of the week. Recently there's some tariff stuff going through that may have huge implications. I would think if you talk to anybody in a company right now, they went, like, for example, Wildfire or others, they've spent hours and days of their life going through and trying to figure out which factory they can have their stuff produced on. I mean, that's one part. And then it's the pricing. It's like, well, when do I raise prices? Do I raise prices? How much do I raise prices? So, so many questions and time that's been spent. And so, yes, been a big impact, but it just varies on categories.
Yeah, I think I'd say the same thing. It just depends on the category. I think if you're, I don't think it's easy for anybody. Maybe if you're in soft goods, there's more geographies that are making soft goods than the other end of the spectrum. Probably like high-end carbon fiber. Like where are you going to make that? China, Taiwan, Cambodia, Vietnam,
Toronto. Toronto.
At scale.
Okay.
Where are you going to make it? They're just super limited. And I think everybody knew the China issue was going to be there. I don't think people expected Cambodia to be so high on the list. And then at the same time, you have to look at, I guess maybe if you had a $20 hat and the price went to $30, people maybe they'd be like, okay, there's some elasticity there. But then you also go, same thing, if they look like high-end bikes, you're like, well, it's already, ask everybody if they already think the price is reasonable. Now it's like, oh, it's already expensive. Do I want to go from 8,000 to 12,000?
Yeah. So
like, not only are you highly concentrated in your supply chain, you're also very restricted on elasticity. So you kind of have to weigh that, and kind of when to do the pricing change. But is it going to be accepted by the consumer? Yeah. Some categories I think will probably be okay, and others are, just like heartbreaking in how challenging it's going to be.
We spend a lot of time studying the consumer and, willingness to, like, to Russell's point in terms of accepting price increases. And you look at, we had experience selling a really high-end bicycle business out of Italy several years ago, and that they serviced a consumer that was pretty price insensitive. So you're talking 15,000 euros for a bicycle. If pricing goes up for that consumer, they may not care as much. Why? Because they've got 3 or 4 of these bikes in their garage next to a Porsche and a Lamborghini. So there's certainly, I think, also category, but also the consumer and the willingness to accept price increases as well is different across the industry.
Yeah, there. As you guys know, there are certain categories where, either you're at the high end, as you always kind of say, like Ferrari's done pretty well through many recessions. If you're buying a Ferrari, you're buying a Ferrari. You probably have the cash, good times and bad. But these categories where people, it's not just their hobby, it's their lifestyle, if not their identity. They're probably going to continue to spend, and that it could be cycling, it could be fishing. They're just categories where they're going to spend. It's top priority.
I got it. So I think most people on this side of the room know there's not a lot of Steves out there, as you mentioned, in firms like that. But I'm kind of wondering about the next generation of Steves or the new funds that might pop up. Is there LP money out there that has the same kind of interest, whether it be business or even altruistic in the form of supporting the next generation of outdoor?
Why, there's not a lot. Right?
Yeah, I mean, I sure in the hell hope so. Um, yeah, I don't know if I have a great answer.
Yeah,
For that. I can't. I don't have a crystal ball. I wish I did. If I did,
I mean, it's hard.
I'd be richer.
I feel sorry for Steve sometimes because I know every person in the industry that needs money goes to him because there's so few people that do what you do.
I would say there's not that many people. There are a lot of folks. There are a lot of angel investors in this industry. A ton of angel investors. There's a lot of people out there with 20 grand, 50 grand, et cetera, and you can start a business with 5 or 6 of those. And I think that's really important. Is that you don't necessarily need me. You may need me at a certain point, but you can get your business off the ground. And my hope is that some of those angel investors will end up, building a fund like myself. But I also think that with more exits and folks within the industry are reinvesting more money into other companies. I know we had a panel yesterday. I know there's individuals that I work with that are investing in companies. So I don't know what the outlook really is, but I believe there are. I don't know. That was a terrible answer, but
No, that's good.
yeah,
Same thing.
best I could do. Yeah.
Yeah, I wish outdoor had more of that. Where you have a big exit, set up a fund, and kind of repopulate the next, kind of the next generation, right? I think you probably see it less in this industry than others. Yeah.
Yeah.
Yeah, where they set up a family office and it's just the same. I was talking to a new family office this morning that likes outdoor and active lifestyle, but they're same thing. Like, 5 years of at least $1 million EBITDA will invest.
Yeah.
And you're like, what about the emerging guy?
Yeah.
Dude, support them too.
Yeah. It's tough.
Great questions. All right, we are at time. So if you have follow-up questions, please hit up our panel. Thank you so much.